Good evening. Today, we report on a dramatic shift in the silver market that unfolded over the past 24 hours. On March 3, 2026, silver prices fell sharply to $82.17, triggering widespread forced liquidations across the paper futures market. Margin calls intensified as leveraged positions were closed by automated trading systems, leading to unusually high volumes and a rapid decline in contract prices. Retail investors observed their accounts declining in real time, while mainstream financial networks reported the event as a severe setback for precious metals. However, the decline did not reflect a fundamental loss in silver's value. Instead, it was the result of mechanical T+1 settlement processes and temporary shifts in the dollar index, causing algorithmic liquidation to dominate market activity. Observers noted that while paper prices fell sharply, physical silver availability remained constrained, with dealers withdrawing inventory and premiums on coins and bars rising. The following day, March 4, 2026, silver rebounded to approximately $85, reflecting a V-shaped recovery as institutional buyers returned to the market and mechanical pressures subsided. This sequence highlights the distinction between short-term algorithmic volatility and underlying market fundamentals. The March 3 decline began with silver opening near $87 and briefly climbing to $88 before sustained selling pressure drove prices lower throughout the session. The daily trading range reached $6, while the number of contracts traded over 6 hours exceeded a typical week's activity, underscoring the mechanical nature of the sell-off. Analysts explained that the T+1 settlement system forced leveraged institutions to liquidate positions rapidly when the dollar index spiked, resulting in algorithm-driven sales rather than a reflection of market sentiment or safe haven demand. Meanwhile, physical silver remained in high demand, with limited supply and elevated premiums confirming the ongoing strength of the underlying market. Once the forced liquidations concluded, buying activity surged, leading to the rapid rebound observed on March 4th. This dynamic illustrates how paper futures markets can temporarily diverge from physical market conditions, and why short-term declines may not indicate lasting price trends. In addition to these immediate market movements, broader geopolitical and economic factors continue to influence silver demand. Escalating tensions in the Middle East, declining equity markets in Asia, and capital flows from emerging markets into hard assets reinforce the appeal of precious metals. Physical silver inventories remain low, and premiums on coins and bars reflect strong retail and institutional demand, independent of the paper futures market. Historical patterns show that mechanical liquidation events often precede rapid recoveries once temporary pressures subside. The recent V-shaped reversal established a technical support level at $82, which now serves as a reference point for future trading. Analysts note that institutional participants are closely monitoring these levels as they re-enter the market, further supporting upward price movement in the near term. In conclusion, the events of March 3rd and 4th, 2026, demonstrate the interplay between algorithmic trading in silver futures and fundamental physical market dynamics. The sharp decline to $82.17 reflected mechanical forced liquidations rather than a change in demand. Following the resolution of these liquidations, silver quickly recovered to $85. Highlighting the resilience of the physical market. Market participants are advised to distinguish between short-term mechanical volatility and long-term trends driven by supply constraints, industrial demand, and geopolitical considerations. Physical silver remains in limited supply, and institutional buying has reinforced support levels while premiums continue to rise. As these developments unfold, ongoing monitoring of both physical inventory and institutional activity will be essential to understanding future silver price movements within the context of global economic and geopolitical pressures. This concludes our coverage of recent silver market activity, providing a factual and professional account of events for informed analysis.